Balance sheet is important, no doubt about it, but more than balance sheet, P&L is more important. Balance sheet is something that you need to look at once in a year. P&L is something that you need to look at on weekly basis, if not on day-to-day basis. So how do we understand balance sheet? See, the balance sheet has got five components, or five components. Number one, it has got something which is known as equity and liability. Number two, it has got non-current liabilities and current liabilities. On the asset side, so this you can read as equity and the liability side, and under the equity and liability side you can read point A is your shareholders fund. Shareholders funds. So that is your equity. Shareholders fund would mean money that the shareholders have put into the business. Then you got a non-current liabilities. So what are the non-current liabilities? What are the current liabilities? Current liabilities are the liabilities of a business that need to be discharged within a period of 12 months from the date of the balance sheet. That is your current liability. So money that you need to pay to your suppliers is a current liability. Money that you need to pay for housekeeping is a current liability. Then you have something which is known as non-current liabilities. Non-current liability would mean a liability which is not a current liability is a non-current liability. Meaning what? Meaning non-current liabilities are those liabilities of a business that need to be discharged by the business beyond a period of 12 months. So that is the only difference between the current liability and the non-current liability. We will understand as to what all will fall under these heads. Then you have a non-current assets and the current assets. So what are the current assets? Current assets are those assets of a business that is expected to get converted into cash. So that is your current asset within a period of 12 months. So inventory is current asset. Why? It is expected to get converted into cash within a period of 12 months. Receivable is an example of current assets because receivables is something that you expect to be paid back to you by your customer within a period of 2 months, 3 months, 4 months, as may be agreed between you and your customer. Non-current assets, again simple. Non-current asset is an asset which is not a current asset. So what are the examples of non-current assets? So building, plant and machinery, computer, furniture, land. These are all examples of non-current assets. Please remember the relationship between the current assets and the non-current assets. Current assets are expected to get converted into cash within a period of 1 year. Non-current assets are used for converting current assets into cash. So how will you convert inventory or raw material into cash? By using your building, plant and machinery, land, right? Isn't it? So you will all those assets process the raw material using your plant and machinery, and that is how the non-current assets are used for the purpose of converting current assets into cash. So let us understand few examples. So under the shareholders fund, what you can have? You can have equity share capital. Equity share capital is the capital that you issue to the owners of the company. Owners of the company. So who is the owner of the company? Someone who is holding equity share. He is the owner of the company or she is the owner of the company. A company can also issue preference shares. So what is a preference share? Preference shares are slightly different from the equity share. Equity shareholders are owners of the company. Preference shareholders are not owners of the company. Preference shareholders contribute capital to the business, but they do not take the risk. So when I say they do not take the risk, what does it mean? It means preference shareholders will have a preference, number one, in getting the dividend paid first. So before the company pays dividend to the equity shareholder, company will have to pay dividend to the preference shareholder. And number two, in case if company is closing down for whatever reason, the money will be paid back to the preference shareholders first before it is paid to the equity shareholders. Then you have something called as share premium. So what is share premium? Share premium is I'm sure some of you may be fortunate to have applied for the IPO of Paytm. So when Paytm came out with a public issue, they issued the share at a price of 2250. So that means for every share they collected 2,250 rupees from you, and they gave you a share of 1 rupee. So this is the issue price that they collected from you, and this is the share price or the face value of the share, that is rupee 1, and they collected 2,249 extra. So what this is, this they have collected for, this is what they have collected for as share premium. So ये जो amount है, this amount will sit in the balance sheet of a company as part of the share premium. And then you have a figure of reserves and surplus. Now what is reserves and surplus? I'm sure you will remember we talked about the retained profit. So the profit that you retain in the business, that gets reflected as reserves and surplus in the balance sheet of a company. Under the non-current liabilities, you got a long-term borrowing, so which means money that you have borrowed from a bank or from a financial institution or from someone else, which you have to pay back to them within a period of beyond a period of 12 months. It will be part of your long-term borrowing. Then you got a deferred tax liability. So sometimes because of various tax provisions, you do not pay tax today, but you are going to pay the tax tomorrow, right? So that will reflect in the balance sheet as deferred tax liabilities. Then you got other long-term liabilities. So what are the other long-term liabilities? Please remember, borrowing is what you get from a bank or from someone in cash, and liabilities is something that you do not get in cash but you get in kind. Let's say, for example, you imported a plant and machinery from a company in Germany. That company in Germany has given you a credit line of 2 years. So this machine that you have purchased from a company in Germany, the payment will be made by you after 2 years. So therefore, the amount that you owe to that company will reflect in the balance sheet as part of long-term liabilities. Then you have something which is known as long-term provision. So please remember, what is a provision? So provision is an expense which is going to be incurred in future, but you do not know as to what that amount is. Okay, provision is something, an expense which you are going to incur in future, which you are going to pay in future, but you do not know as to what that amount is. So let's say, for example, superannuation, provident fund, leave encashment, gratuity. Now, as a business owner or as the business, you have to pay these benefits to your employees as and when they superannuate. So how much this amount is going to be in future, today you do not have an idea, but you need to make a provision year after year based on the estimates. What is their current salary? How many years have they been in the company? What is their basic salary? And things like that. So all that provision, all those amounts that you are going to pay in long term on account of certain expenses that you do not know today as to how much that amount is going to be exactly, will be reflecting as part of your long term provisions. Current liabilities, short term borrowing, the money that you need to pay to your suppliers, money that you need to pay, the short term borrowing is the money that you have borrowed from the banks for the purpose of working capital. So the loan that you take from a business for the purpose of working capital is your short term borrowing. Trade payable, money that you have to pay to your suppliers. Other current liabilities, so you know what is the MSCB bill for the month of March, which is going to be paid in April. So when you are preparing your accounts for 31st March 25, this MSCB, this power bill or this bill of the housekeeping or this bill of canteen, they are going to be paid in the next month. But you know what is that amount is. So that will come in the balance sheet as other current liabilities. Short-term provision. So long-term provision we discussed. Long-term provisions are the expenses that you're going to incur in the long term, and similarly there are expenses that you incur but you do not know as to what that amount is, but you are definitely going to pay it one day, which is going to happen in next 12 years. So the automobile companies, when they sell cars, they give warranty. So warranty expense is going to be incurred in next 1 year. So these automobile companies will need to make a provision on account of warranty, and that will come here. Non-current assets, under the non-current assets, you got a tangible assets. So your land, building, property, plant and equipment, computer, furniture will be part of your tangible assets. CWIP, that is capital work in progress. So what is capital work in progress? Capital work in progress is, let's say you are setting up a factory, and you are setting up a factory. So you have purchased the land, you have started constructing the building, and you also have got some of the plant and machinery already purchased. Now all these expenditures that you have incurred will be part of your capital work in progress. Why capital work in progress? Because the project is yet to complete and the project is yet to commission. So the expenditures that you will incur of capital nature are referred as capital work in progress. So one day when this capital work in progress is complete, so whatever amount is appearing as part of the capital work in progress, the project is complete, then this amount will become zero, and whatever that amount is coming here will be added to your tangible assets. Intangible assets under development. So if your company is working on design or patent, whatever expense that you are incurring will be part of your intangible assets under development. Non-current assets. So non-current investment. So sometimes you may have started a new subsidiary. So whatever money that you have put into the subsidiary is going to be your non-current investment. Non-current investment means investment that you have done with an intent to hold it for long period. That is your long-term investment. Long-term loans and advances. So sometimes to your suppliers, to various other government authorities, you have to give advances. So, and if those advances are given for a period longer than 1 year, then those will be classified as long-term loans and advances. Inventory, we all know. Trade receivables, also we all know. Cash and cash equivalent, also we know. Short-term loans and advances in your business. The employee is going on a travel, so he's taken an advance for travel, or an employee has come to you and asked for some advance against his salary. So all those will be part of your loans and advances. So other current assets, something which is not getting classified, will be coming as other current assets. Current investment. So let's say you have some money lying with you for 2-3 months, and you don't know what to do with this money. So instead of keeping that money in the bank, what you will do, you will put this money into the mutual funds or into debentures of some company or shares of a company which are safe to invest for a short period. So whatever such investment that you will do will come in the balance sheet as part of your current investment. So friends, as I said, fortunately or incidentally, balance sheet is important, but the balance sheet is much shorter for the purpose of understanding. Profitability, of course, is more important, and that is why it needs more time to understand. So before we still have 10 minutes, and before we come to the cash flow statement, we can take 1 or 2 questions that relates to the balance sheet, and then we will go to the cash flow statement.
They said there are 2 questions for Swati. It says current assets are going to be converted in 12 months or by 31st March.
Okay, good question. Good. So the very good question.